Thank you for choosing to attend this presentation. I have a question for you. What is the one word you have heard more than any other during this conference? Show of hands, please. All right? Risk. Everybody got it. Risk. Risk is all pervasive at this time. My topic is understanding and managing risks in management system auditing. Now, auditing is risky business, wouldn't you agree? I assume you're all auditors. You've done some auditing. You're probably certified auditors. It is fundamental to the audit process. And auditors who do not take risk into consideration are treading on slippery ground. A little bit about me. My name is Jacob McLean, of course. I'm the principal consultant and managing director of Kaizen Training and Management Consultants Limited. I'm a PECB certified trainer, ISO 9000 and 14001 master, PECB certified advanced management system auditor, and my colleagues are right there. I am also a certified implementer, lead implementer for ISO 22301, and a certified lead risk manager, ISO 31000. My company is a partner with PECB, operating in Jamaica, and I have over 22 years in management systems auditing and development. I'm going to give a brief overview of what we're going to talk about. Understanding risks, understanding the management system audit, risk related to management system auditing, and I'll take a brief look at finance and accounting. I'm not a CPA, however, I do have some knowledge having studied accounting and finance in college. We look at what the auditing standard, the current version, ISO 19011-2011, has to say about risks in auditing. We'll also look at ISO 17021-1-2015, which is a standard governing certification bodies. We'll talk a bit about risk-based auditing, and then we'll look at risk related to audit programs and certification audits, and then I'll field your questions. Risk is defined as the effect of uncertainty on objectives. We understand that this can be either positive or negative. It's the combination of consequences and likelihood. Simple, it can be an equation, so we can calculate risk. The presentation will focus on the negative aspect of risk. Of course, the effect that we want to ensure that we negate is negative. In other words, affecting the outcome of the audit in an unfavorable way. We want to make sure that we mitigate any possible risk that there may be to achieving our results. Audit risk. From a financial perspective, audit risk is a risk that an auditor expresses an incorrect conclusion. That is, concluding, for instance, that an audit report is justified, whereas there is doubt. Issuing a qualified audit opinion where no qualification is necessary. Failing to emphasize a significant matter in an audit report. Providing an opinion on financial statements where no such opinion may be reasonably given due to significant limitation in the scope, in the performance of the audit. That's from a financial perspective. Risk is integral to management system auditing. Risk is inherent in the industry type. Oil and gas, for instance. We heard so much about BP, we heard about ExxonMobil, we heard earlier in an earlier presentation on the Deepwater Horizon, and there have been so many incidents related to particular industry types. It's related to the controls implemented in the management system, and we'll speak about management assertions later on. The audit process itself is based largely on sampling. We select a sample, analyze the sample, and we make certain decisions. And those decisions are often significant. They can lead to liability. We don't often consider the fact that we are offering opinions which organizations are relying on, and therefore our own integrity as auditors is at risk. What knowledge should auditors have? Auditors should have sound knowledge of risk management principles. Of course, ISO 31000 is a gold standard for risk management, enterprise risk management, and the companion standard to that, ISO 31010, provides various risk management methodologies or the assessment, dealing with the assessment of risks. So the auditor needs to understand the methods, the techniques relevant to the discipline and to the particular sector, such that he can evaluate and control the risk associated with the audit program. So risk assessment and mitigation, risk treatment, and we need to, of course, be flexible, the adaptive approach. We heard earlier about the proactive approach in the lunchtime presentation. Reactive measures are often too late. The horse has gone through the gate, so we need to focus on the upfront measures. We'll talk about that a little later on. We all, I imagine, are aware of what an audit is. ISO 2011 defines the audit in clause 3.1 as a systematic, independent, and documented process for obtaining audit evidence and evaluating it objectively to determine the extent to which the audit criteria are fulfilled. So that's what an audit is. It doesn't mention risk in this definition. You wouldn't expect that. However, we are evaluating, we are gathering evidence, we are evaluating the evidence. And of course, we are humans. We are not perfect. No system is perfect. Therefore, it's fraught with risk. We rely mainly on sampling. The risk associated with sampling is that samples may not be truly representative of the population from which they are selected. So the auditor may draw conclusions that are biased. The particular method of sampling, random sampling, stratified random sampling, the method you use is so very, very important. There may be risks depending on the variability within the particular population. This is a fact that must be considered. Sampling. Audit sampling typically involves several steps. Objectives. We must arrive at the objectives of the sampling. We're going to develop a plan. What are the objectives? Selecting the extent and composition of the population to be sampled. Selecting a method. What sample size? Decisions must be made up front, prior to the audit. So we'd have done our background work, we'd have studied the organization, we'd have done that before, from the initial contact stage. Then we decide just how much do we need to sample, conducting the actual sampling activity. then compiling, evaluating, reporting, and documenting the results of our sampling. Some more on sampling. When a statistical sampling plan is developed, the level of risk involved must be taken into consideration. This is often referred to as the acceptable confidence level. For example, a sampling risk of 5% corresponds to an acceptable confidence level of 95%. What do you want? What is your aim? A sampling risk of 5% means that the auditor is willing to accept the risk that 5 out of 100, that is 1 in 20, of the samples examined will not reflect the actual values that will be seen if you focus on the entire population. You have to understand that sampling is fraught with risk. Hence, auditing is risky business. There are other auditing risks. So sampling is significant, but there are other audit risks. Risks to the organizations that are created by the audit itself. What are these? The very presence of the audit team on site is a risk. Can influence health and safety, environment and quality. There's threat to the auditee's products, services and personnel or structure. For example, contamination of clean rooms, depending on the type of organization that is being audited. There are time constraints. Yes? I have never performed an audit or been involved in an audit where there's not time pressure, significant time pressure. We can cut corners, but of course, being people of integrity, we would not do that. But there is always that time pressure. Independence. We must recognize that there must be constant scanning to ensure that there is independence. So members of the team must be independent. How have they worked for the organization? Do they own shares in the organization? Is there any connection? There's always that risk of compromise. Audit team dynamics, there are risks involved in there as well. Possible conflicts. So in even choosing the audit team, if you're the lead auditor, you should choose based on your assessment of the need that the team will need to address. So for instance, do you have the right mix? Persons with the required knowledge? What about behaviors? Emotional intelligence is important. Will the team meld and work together? Let's talk about the concept of materiality. This is very germane to finance, but also very relevant in other management systems. So limiting audit risk in order to provide reasonable assurance requires that an auditor places emphasis on processes and systems that are material. Materiality refers to significance. Significance of the process. We heard just now, if we have 50,000 or 10,000 units connected to the system, how many are we going to focus on? Certainly not all of them. We need to drill down to the critical few and focus on those. Reasonable assurance is a level of confidence that the financial statements are not materially misstated, that an auditor exercising professional skill and care is expected to provide, having performed an audit from a finance perspective. Applicable across the board to management systems as well. It is based, materiality is based on the significance of a process, the procedure, and the other elements of the management system. We as auditors must make our own determination. What are the core processes related to this management system? What are the key and critical procedures? A single critical element or a combination of less significant ones can be considered material depending on the overall impact of non-conformance on the management system. So an accumulation of small failings can become significant. For instance, if you're auditing documented information and you see lack of control in a particular department, and you follow through and you recognize it is elsewhere, it may be minor, however, you're going to conclude that overall this organization does not have a sound control system in place for documented information. It may be that there's a major breakdown, but an accumulation of small failings can be significant, can be material. So auditors need to bear materiality in mind. It is very, very important and critical. This slide speaks about materiality from the perspective of finance as well as management system. So financial auditors evaluate materiality in financial terms, as ultimately what they measure is reported in dollars. So and of course, different organizations have different levels of what is considered material. So an organization that is $1 billion company, to them, $50,000, oh, that's peanuts. But if it's a few million dollars per year, then $50,000 is going to be material. From the management system perspective, auditors must evaluate materiality based on the significance of the process that is in scope. What process? How critical? How important? It is a fact that we sometimes do not consider materiality. We are there to audit, and we start and we go right through without stepping back and doing the necessary assessment. The International Standard on Auditing 320, Materiality in Planning and Performing an Audit, gives quite a bit of information. I won't go through all of this, but misstatements, including omissions, are considered to be material if they, individually or in aggregate, could reasonably be expected to influence the economic decisions of users taken on the basis of the financial statements. Again, this is from a financial perspective. Judgments about materiality are made in light of surrounding circumstances and are affected by the size or nature of a misstatement or a combination of both. The possible effect of misstatements on specific individual users, whose needs may vary widely, is not usually considered. As auditors, we face various situations from time to time. I recall in a training session that I attended, the trainer mentioned that they were involved in an audit. And in this particular audit, it was a partnership. The auditor recognized that the quality policy was not signed. He took off his glasses and he said, "You know, I'm not wearing my glasses today." And he gave enough hint so that the auditee recognized that there was an issue. And sure enough, picked up that the policy was not signed. He said, "Tomorrow I will be wearing my glasses." Of course, the following day came, the policy was signed. Problem corrected. Was that good or bad? Well, it just so happened that a couple months down the road, as often happens, the partners had some issues. Partnership had to be dissolved. During the due diligence process, it was found that a number of documentation had not been properly addressed. Signatures were missing. There were issues related to how the assets of the partnership should be divided. Had the auditor found a non-conformance, which was clearly evident, root cause analysis would have required them, the auditee, to evaluate, to assess all documentation to make sure that required signatures were in place. The pain that was caused would have been averted. And therefore, it is very significant that we, as auditors, give due attention to calling it as it is, not overlooking. It may not be significant, it may not appear significant, but we must ensure that it is called what it is what it is. A maxim in ISO is that you say what you do what you say, and be able to prove it with records. AI's CPA, Materiality and Management Systems, 4 major considerations should be taken into account in assessing materiality. Risk appetite of management, which will determine the levels of errors acceptable. Organizations have risk appetite, the risk that they're prepared to tolerate and live with. Auditors' tolerance for risk. What confidence level am I prepared to work with? The client's risk appetite. So you're working for a certification body. What's their risk appetite? We must also take into consideration possible accumulation of minor errors. As we said earlier, accumulation of minor errors can be material. This slide speaks to factors influencing materiality. I won't go through all of them, but the first one there, criticality of the processes. So criticality of business supported by a system or an operational process. So how critical is a particular process in the business? That must be assessed. Cost of the system in terms of material, software, licensing fees, or a combination of these. Potential penalties in cases of failure. Non-conformances. We're talking here about legal or regulatory or contractual conditions. Very, very critical. These must be taken into consideration, and risk is inherent in all of this. The concept of overall materiality. This is the amount of errors that auditors are prepared to accept in the documentation review as a whole, while still concluding that they provide a true and fair picture of the audit. So what are you going to accept, knowing that the risk is inherent? That's dependent on you. It also takes into consideration the client and, of course, the management. The auditor should assess the magnitude of error or materiality level before audit commencement. This should be based on understanding of the auditee, the business sector, and the industry. Now, we're talking about the entire audit process, starting from stage 1. So, from the initial contact, what we want to focus on here, validation of materiality related to the particular industry, inherent risks. This will be further looked at during the audit, the stage 1 audit, validation of materiality related to control risks, documentation that is in place, procedures, etc. Site audit plan. So you make the decision. Actually, the stage 1 audit is usually done on site. In former days, you'd send your documentation to a certification body, they would review, but now we want to be on site, we want to get a sense of what's happening at the organization before we move to stage 2. This is the actual on-site audit. Here we're going to validate materiality based on the detection risk. So we're going to be auditing procedures, we're going to be looking at management review records, we're going to be looking at risks, opportunities, and all of that. And we're going to be using the methodology of sampling. Looking at each area, each stage in turn, materiality must be built into each step of audit planning from the initial contact. Here, it is taken into account when we determine the duration of the audit as dictated by the inherent risk related to a particular organization, industry type, the applicable laws and regulations, employee population, number of workstation, number of management systems. So if it is an integrated management system, that's different from a single management system. At stage 1, we want to look at the key processes, the interactions, sequence and interaction, determine the areas of focus during the on-site or stage 2 audit. So we want to look, see, make the determination and plan for the stage 2 audit. At the stage 2 audit, the on-site audit, we want to adjust our sampling plan based on materiality of the processes which we would have determined at the stage 1. There are other factors that we take into consideration. What audit test methods are we going to use? Document review, interviews, observation, technical verification, analysis. We choose beforehand the methods we're going to use, having done our assessment. We also want to take into consideration our audit team experience. How are we going to deploy the audit team members? Where are they going to be focusing? The components of audit risk are significant impact on audit planning. So we take all of these components into consideration when we're planning the audits. So we look at inherent risk, control risk, evaluated in relation to planning, performing, and evaluating of document information. And the right mix is so important. The right mix of essential procedures are key to ensure that detection risks, audit risk, reduce to a level that is acceptable to you, the auditor. An assertion, let's talk about management assertion. So management has assertions, various assertions. We are going to test these. An assertion is expressed or implied representation by management about financial statements of a business and their components. A list of possible assertions represent all the various manners in which a specific control could affect a particular caption with the corporate income statement and balance sheet from a financial perspective. Won't go through all of that. There are various examples of management assertion. And again, I won't go through all of these. Completeness, all transactions or other events that occurred during a specific time period were indeed recorded for the period in which they took place. Completeness, we want to test that. Existence or occurrence, is what is purported to be in place really in place. Accuracy of transactions, balances and classifications have all been correctly processed and recorded for the correct time period. Again, very, very critical in relation to finance, but also in relation to management systems, ownership and rights, presentation or disclosure. I've been at the other end. So I learned as an auditee to answer questions that are asked, not to disclose voluntarily. But as auditors, we want to probe, and we know we focus on asking open-ended questions. We want to ensure that we discover any latent non-conformances. We're not seeking non-conformances. We really want to assist the auditee. However, we don't want to overlook a potential non-conformance. Measurement and or evaluation. All transactions are mathematically correct and appropriately recorded in the correct time period. That's important for finance. And of course, combinations of these. Materiality risk assessment should be done on the following. Now we're looking at it now in relation to management systems. So documented information. We want to make keen assessment. Internal audit report. These are key processes. Risk assessment report. Actions to address risks and opportunities. The management review. Outcome of interviews with top management. These are areas where we want to ensure that we focus on materiality. Statements that are made. How significant? What are the implications? Can we have confidence that the management system is in conformance based on what is presented? Let's look at what is referred to as the audit risk model. Audit risk is equal to inherent risk related to a particular industry, control risks related to assertions, procedures, statements, so on, and detection risks. So that's the composite of audit risk. Looking at them in turn, inherent risk is a risk of a material misstatement in the financial statement. We spoke to that earlier. It is generally considered to be higher where a high degree of judgment and estimation is involved, or where transactions of the entity are highly complex. So again, this is related to the particular organization. Control risks. Risk of material misstatement in the financial statement arising due to absence or failure in the operation of relevant controls of the entity. Procedures, are they addressing the relevant issues? Now, in the new version of the standard, the 2015 version, there's no requirement for a procedure, a written procedure per se. But where the absence of procedure would result in a non-conformance, the auditee is advised to have a procedure. This doesn't have to be in paper form. It can be in any medium. But it is an area that we want to focus on. What controls? How are those controls deployed? Control risk is considered to be high, where audit activity does not have the adequate internal controls to prevent and detect instances of fraud or error in the financial statements. Detection risk is a risk that the auditors fail to detect a material misstatement in financial statements. An auditor must apply audit procedures to detect material misstatements in relation to finance. In relation to the management system, quality or environment, the principle is equally applicable. We use methods to determine whether or not what is presented is truly representative of what is happening in the organization. And misapplication or omission of critical audit procedures may result in a material misstatement remaining undetected by the auditor. Detection risk. Some detection risk is always present, and this is due to the inherent limitation of the audit because it is based on sampling. Detection risk can be reduced by increasing the number of sampled transactions. And as we move towards the close, I want to refer to ISO 70001 1-1. Not going to go through all of this. The risk-based approach to auditing, it tells us clearly that auditing must be based on risk. Risk may include, but not limited to, these areas: objectives of the audit, sampling used, real and perceived impartiality, and these are the areas. 2011 as well speaks to risk related to audits. And you can refer to various clauses. So there's quite some treatment here on the nature of audits. Clause 5.3.1, roles and responsibilities of the person managing the audit program. Again, we see where risk is mentioned. Identify and evaluate risk related to the audit program. So it does speak to risk. Similarly, 5.3.4, identifying and evaluating the audit program risks. 5.3.5, establishing procedures for the audit program, again, taking risk into consideration. Let's speak about, briefly, the risk management process. Risk assessment, absolutely critical. Identifying, analyzing, evaluating the relevant risk associating with achieving the audit objective. Identifying, that's the first step. Analyzing, looking at likelihood and consequence. And then evaluating, determining the level of risks, and then coming up with a treatment plan. How am I going to, as an auditor, manage the risk so that I minimize the risk and ensure that they do not impact negatively on my results? There are various options: changing likelihood and consequences, or both, avoiding the risk, removing the risk, or retaining the risk, with, of course, keep knowledge of that risk, keeping it in focus, keeping it on the radar. And of course, there's monitoring and reviewing, being conscious of risk and ensuring that it is a part of our focus throughout the audit. Everybody knows the risk management process from ISO 31000. Establish the context. We consider where we're doing the audit, the organization, particular industry. Identify the risk, analyze the risk, evaluate the risk, and then treat the risk. And throughout all that, we're communicating and consulting, and of course, monitoring and reviewing is ongoing as well. My final slide, a brief summary. Risk is integral in management systems auditing. Therefore, to be effective, the auditor must adopt the risk-based auditing approach, applying relevant risk management methodology throughout the audit process. Absolutely essential. I have some references there. That's the end of the presentation. Do you have any questions? Thank you very much.